Hello and welcome to today's video. In this video, I will examine how investors and business owners should analyze cash flow quality. I will pose certain questions you should be asking, discuss how to perform ratio analysis, and identify red flags to look for. Whether you're an investor or a business owner trying to understand the quality of your cash flow, knowing how to perform cash flow quality analysis is essential for making informed decisions or improving your company's performance. Join me as I break down the steps to a great cash flow quality analysis. By the end of this video, you will have the tools and knowledge to effectively assess the quality of a company's cash flow and to identify strengths and weaknesses in a company's cash flow. This will help you to make smarter investment choices and business decisions. Don't miss out on this essential guide for investors and business owners. And make sure to like, subscribe, and hit the notification bell for more financial literacy content. Join us on this journey to becoming a more savvy investor and business owner. Let's get into it. Let's talk cash flow quality analysis. Let's get into the different steps. Step 1. Answer some relevant questions. Source of cash flows. Is it from the core business? Cash flow sustainability. Are cash flows recurring or non-recurring? Free cash flow, are there adjustments you should be making for these? Free cash flow is equal to operating cash flows minus capital expenditures. When doing your cash flow quality analysis, focus on operating cash flows. Operating cash flow is from the core operations, for example, collecting your receivables. Investing cash flows are from investment in the business, for example, buying equipment. Financing cash flows are from financing activities, for example, borrowing money. High-quality cash flows are from the core business and are sustainable. Low-quality cash flows, on the other hand, are from non-core items, and these are unsustainable. Cash flow is less susceptible to manipulation than earnings, but it's not foolproof. Less judgment is involved in determining your cash flows, which is what makes it less susceptible to manipulation. Here are some non-core sources of operating cash flows. Sales of trading securities. These are short-term securities traded for profit. They're classified as operating cash flows in the statement of cash flows, but it's not a part of a company's core operations, unless you're a financial services company that's involved in selling securities. But typically for most companies, this is not a part of their core operations. Cash flows from acquisitions. Collecting receivables and selling inventories from an acquired company. No operating cash flow is used to generate these inflows, so this is not a core source of cash flows for a company. Cash paid for acquisition is investing cash outflow. Cash flows from acquisitions, for example, collecting receivables, selling inventories from the acquired company. No operating cash flow is used to generate these inflows. Cash paid for acquisition is classified as an investing cash outflow. So this is not a core source of operating cash flow. This is a one-off cash inflow from acquiring a company. This is typically not sustainable unless a company will keep acquiring other companies. As I mentioned, it's a one-time boost in operating cash flows and not sustainable. Unsustainable sources of operating cash flows. Rising accounts payables. This is evidenced by rising days payables outstanding, delaying payment to suppliers. Suppliers may refuse further deliveries. So a company cannot indefinitely improve its cash flow by taking longer to pay its suppliers. At some point, this will start impacting the business. This might give a one-off or short-term increase in operating cash flows, but ultimately it's not sustainable. Selling receivables. Companies sometimes sell receivables through things like securitization or factoring, where they sell the receivables to another company who pays them the cash upfront, typically at a discount to the total receivables that they would receive. Again, this is not a sustainable source of operating cash flows. The company is basically collecting receivables before they are due, and while it will help in short-term cash flows, it's a drag on future cash flows, as the company cannot keep selling receivables. That's not a sustainable way to generate operating cash flows. Advance payment from customers, that's another unsustainable source of operating cash flows. Again, this will help short-term cash flow, but will be a drag on future cash flow, and ultimately it's not sustainable. Customers are unlikely to keep making these advance payments indefinitely, and that will affect future cash flows. Classifying cash outflows as discontinued operations, analysts will typically view this as not a part of the company's normal operations, and therefore it's not shown as regular operating cash flows, as ongoing operating cash flows. But this cannot continue indefinitely, and the company cannot keep classifying parts of its operations as discontinued. So again, this is not a sustainable source of operating cash flows. Capitalizing expenses, for example, capitalized software. This increases earnings and operating cash flows. Subsequent amortization, which is a non-cash transaction, does not reduce operating cash flows. By capitalizing these expenses, the company is able to increase its operating cash flows. And down the road, when it's amortizing these expenses quarterly or annually or whatever period, which is a non-cash transaction, it does not reduce operating cash flows. Ultimately, this helps the company in the short term, but this is not a sustainable source of operating cash flows. Free cash flow, are there adjustments you should make? This is another question. Free cash flow is operating cash flows minus capital expenditures. Capital expenditure refers to capital investment, for example, buying equipment. For companies with acquisitions, adjust free cash flow for cash paid for acquisition. So this reduces your free cash flow. That's one adjustment you should make. Operating cash flow minus capital expenditures minus cash paid for acquisition gives you your free cash flow. And cash paid for acquisitions is an investing cash outflow. So adjusting your free cash flow for your capital expenditures and your cash paid for acquisition results in lower free cash flow. Purchase of intangible assets such as patents, trademarks, and copyrights. Other expenditures for business investment. These are all things you should deduct to arrive at your free cash flow. So all these non-operating cash flow items need to be backed out of operating cash flow to arrive at your free cash flow. This is the cash flow that you ultimately have to spend. So do not just focus on your operating cash flow, but adjust the operating cash flow for these other items as well. Continuing with cash flow quality analysis, I will now look at ratio analysis. There are fewer ratios for the cash flow statement compared to the income statement and balance sheet. Some ratios may include an income statement or balance sheet item, a bit of a combo ratio there. You should review ratios for large changes or trends, whether upwards or downwards. And ratios can be used to identify cash flow statement risks. Here are a couple cash flow statement ratios, how they're computed and what to look for. Operating cash flow ratio. This is a liquidity ratio and it's computed as operating cash flows over current liabilities. If it's below 1, operating cash flows might not be covering current liabilities. Cash flow to net income. This has characteristics of both profitability and liquidity ratios, and it's computed as operating cash flows over net income. This ratio measures the conversion of earnings to cash, that is, how quickly a company can convert its earnings to cash. If it's below 1, it could signify issues in collecting receivables, and the company could possibly be recognizing revenues before it has met the revenue recognition criteria. Some balance sheet ratios can also indicate cash flow quality issues, and some of these ratios to consider include days sales outstanding, which measures how quickly a company collects its receivables, days inventory outstanding, how quickly the company takes to convert its inventories to sales, and days payables outstanding, how quickly the company pays its suppliers. So all of these issues indicate liquidity and affect a company's liquidity. So analyzing these ratios as well can help you to understand a company's cash flow quality, to assess a company's cash flow quality. And the final step for cash flow quality analysis is to put it all together. And this should actually say step 3, not step 4, as we skipped one step in the cash flow quality analysis, which was a common size analysis. So in the final step, you combine your findings from steps 1 and 2, and then you assess your overall cash flow quality, similar to how you assess your quality for the income statement, your earnings quality, and your balance sheet quality. So that's the final step in your cash flow quality analysis, where you put it all together. You document the findings from the questions you asked and from the ratio analysis which you did. Then you combine those findings with your earnings and balance sheet quality analyses, and that's going to give you your overall financial statement quality. Some industries are typically harder to analyze than others, so bear that in mind as well. And a consistent process improves your analysis and decision-making capability. So just keep doing those cash flow quality analysis and your earnings quality and balance sheet quality analysis, and eventually you'll master the process of financial statement analysis and being able to tell how a company is performing, whether you're an investor or a business owner. That brings me to the end of this video. So this is the final one in the series on earnings quality, balance sheet quality, and cash flow quality analysis. And putting together these 3 analyses will give you your overall financial statement analysis. And that's it for the video. Thank you for joining me on this video. Hope you learned a lot, and we will continue our journey in bringing you financial literacy content on this channel. Thanks for watching the video, and see you in the next video.